Good afternoon, everyone. Hi, I'm Brian Overby. I am the Senior Option Strategist at Options Play, and welcome to today's event. It's going to be a little bit more advanced than I say we normally do when we're dealing with retail customers, and in particular the ones over with First Trade. A little bit more astute is what I've found through doing these seminars. A lot of great questions that we get, and let me bring that up in that if you do have any Q&As, this is an interactive session. There is a Q&A box. Just click on that, and it's got the question mark on it, and if you put that in there, I'll be paying attention to it, and I'll try to answer any questions along the way. Also, there is a chat box. That chat box is only open to the people that are hosting the event, the panelists. All right, so let's get started. Here is multi-leg option strategies. One of my favorites. It's a trade that I like to do quite a bit, and we're going to focus on the butterfly side of things. And then we're going to come back in a couple weeks' time, and Tony's actually going to talk a little bit more about four-legged trades. We're going to go into iron condors and alike. So before we get too far, I want to let you know that nothing that we do today is meant to be a recommendation. Past performance isn't a guarantee of future results. And if you are going to trade options, this is from the First Trade side of things, you must receive a copy of the characteristics and risks of standardized options. It is all over the First Trade platform, and if you would like, you can actually send them a message and get a hard copy if you would like. So anything, if you're going to trade options, you do need to read that and realize that options are risky, and sometimes you can lose your entire investment when you are investing in options. Four basic trades. So we're going to take these four basic trades and we're going to make one advanced trade. So in our instance, if you are buying options, you're going to get the right to buy the underlying. If you buy a call option, the right to buy means that you want the underlying market to go up. But we're going to come out and we're going to actually sell some call options, and we're going to take on an obligation. So to go along with this, we buy a call option, wants the market to go up. You sell a call option, you want the market to go down, but you get cash, and that cash helps pay for that call option. And then we're going to actually go out and add another leg, and we're going to buy another call option, and that's going to protect us on the upside. So if you go down and you look at any complex strategy, it all starts from these four basic trades. And we're going to look on the call side of things mainly, but also everything that we talk about today can be done on the put side. And usually, if we're talking about butterflies, the reason why we use calls or we use puts is to try to get directional on our trade. So to start off with, let's look at just a standard butterfly with calls and how that setup works. Now, in this day and age, in the advent of zero DTE option contracts and a whole bunch of different expirations that are available, butterflies are becoming more popular. And it's mainly because you are paying a net debit for a butterfly, but it is a time decay positive trade. In other words, if you are right on your forecast, you want time to decay and you want to get closer to that expiration date. And here's the reason why. If we're doing a butterfly, we're going to be buying one option contract at this level, right, at this strike. We're going to sell two option contracts at this strike, and then we're going to buy one at this strike. So the fact that we're selling these two option contracts, in order to get paid or receive the maximum on your trade, you need those option contracts to go away. So if you're looking at shorter term options, normally the stock would be trading right about where the middle strike is at. And then you have at expiration this wonderful profit and loss graph, a wonderful risk reward in that you pay a little, and if the market does stay where it's at, you receive a lot. In that your risk is going to be the net debit paid, and it's usually fairly inexpensive, but the risk is twofold in that if it goes down, you have risk. If it goes up, you have risk. The only place where you are profitable is if the underlying market stays right where it's at. So the max risk is going to be the width between the strikes less the net debit paid. I'm sorry, the max reward is the the width between the strikes and less the net debit paid. So it's the width from here to here. How wide is that spread minus what we paid for it? The risk is going to be the net debit that we paid for it. So the maximum risk would be whatever we pay to put that spread on. And that's why we have limited and known downside on each side of our profit and loss graph. And then our break even, we're going to have two break even points. We're going to actually, if this is a call butterfly, we're going to have a break even point at this strike plus the net debit paid, and at this strike minus the net debit paid. And that's where we cross the x-axis on our profit and loss graph. Now, we're going to come back. This is a general process, and I'm going to set up a couple of butterflies, and then on Tuesday, I actually filled in for Tony, and I talked about a couple of strategies that we looked at with butterflies, and I'll look at them. Once again, we're going to look at real-time quotes, and it's not meant to be a recommendation. So, but I do want to address and look at what a real butterfly would look like inside the marketplace using the options play platform. All right. So the next butterfly to me is more of a short spread. And let me explain that. So if I sell a call spread or I sell a put spread, I want the market to either stay where it's at or go the opposite direction, right? So we like to say we're neutral to bullish or bearish. If we do what's called, well, in this instance, we're looking at the open wing butterfly. If we do what's called an open wing butterfly, we're offsetting the spread potential, and we're saying if the market continues on up, we don't want to lose in that scenario. And I think we kind of went down the road of setting one up inside the platform on Tuesday. But so here's an open wing butterfly with calls. Okay, so take a peek at that graph, and here's why I like to call this an open wing. If you go here, that's a standard butterfly. Go here, that's the open wing. Standard open wing. Now, you're going to be a little bit more costly. So if you note here, this area, this red area, is a little smaller here than it is here. But by doing that, by paying a little bit more for the trade, we don't have to stay within a range. So back here, we got to be within this range on the standard butterfly. If we open a wing, we can be in that range and still be good, but we can be profitable if the market continues on up. This is an alternative to a long call spread, because we're going to stick with the calls. Or if we're doing it with put, you would flip the graph around, and the profitability would be on the downside, and that would be an alternative to a long put spread. And I do see one question already. No, we don't have access to the slides, unfortunately, TK. We don't. All right. Open wing butterfly with calls. There's a little bit more behind that, but that's the short answer. Open wing butterfly with calls. So now if we do this trade, our max reward, the recording will be available to you though, but I'll just say that. The recording will definitely be available to you. So our max reward is the width between the strikes of the long vertical. It's from here to here. That is our maximum upside on this trade. The maximum risk is going to be the net debit paid, and that's going to be only if the market goes down. And there's only one break even because we don't have the break even on this side, right? So it is this strike plus the net debit paid on that trade. And if we put this whole trade together, well, then on the way up, we are fine. If we continue on up, we're fine. We're only not okay if the market goes in this direction. So the way I like to say this is we have our long spread. We buy this strike, we sell this strike on a call. That means that we have a debit spread that we put on, otherwise known as a bull call spread. And then to pay for the butterfly, normally you do a short call spread. Right here, I'm going to jump back to this slide again. This is the short call spread. Now, if you go wider, you're going to bring in more of a net credit. So the way that I like to explain this is we're going to stop short. We're not going to go as wide. And because of that, it will increase our cost, but it will open up a wing and make us profitable above and beyond that. All right? Does that make sense? So here is our max reward is if we land right here at the middle strike, just like with the standard butterfly. The max risk is, once again, the net debit that is established when we put the trade on, and the break-even price will be the lowest strike plus the net debit paid, and that's where we will break even at. Open wing butterfly with calls. And I want to let you know that open wing is my term for it. Nobody that I know, and I wrote a book called The Options Playbook, they might call it a broken wing, they might call it a modified, but to me, those are the next strategy that we're going to look at. So I like to call this an open wing. And the main reason why is that we're opening up a wing and making it profitable in one direction. Either if we're doing it with calls, it's going to be to the upside. If we're doing it with puts, it's going to be to the downside. Okay. So now we're going to look at the skip strike butterfly with calls. On the skip strike, the last trade was an alternative to a debit spread or a long put spread or a long call spread. Now we're going to look as an alternative to a credit spread using the butterfly. Now with a normal credit spread, you would be looking at setting up a trade where you want the market to stay below your strike and you bring in a net credit, and the goal of that trade is to receive as much of that net credit as possible. That's going to be the maximum reward. On the butterfly, we're trying to get this done for a net credit. We're not paying a debit. But in order to do that, we're going to add some risk to the trade. So as opposed to a standard butterfly or an open wing butterfly, we pay a net debit. We know that that is our maximum risk. Here we're going to have a margin requirement, and I'll explain where the margin requirement comes from. But all that we're doing in this trade is we're adding a spread, a short spread, to pay for a standard butterfly. All right, so if we did the standard butterfly, right, we have equidistant strikes. The long spread is the same width as the short spread on that butterfly. Here, that's not going to be the case. We have a long spread on our call options. We're buying this strike, we're selling this strike. But on the short spread, we're going to skip this strike, and hence the name skip strike, and we're going to buy the next strike out. So if these are 5-point intervals, and let's just center it around 100, right? You'd be buying the 95 strike call, selling 2 of the 100 strike calls. Standard butterfly would be the 105 strike calls, but we skip that. And then we buy the 110 strike call. When we skip that butterfly, we effectively put a short spread inside our butterfly. That means that we add additional risk from this strike on down. That is going to be a margin requirement because it's effectively a short call spread. And I'll look at that when we set one up inside the Options Play platform. But if we look at that, we then say that that credit is used to pay for the standard butterfly. Now the break even, you need to know what strike you're skipping, right? So if this is 5 points wide and this is 10 points wide, we're skipping the middle strike 5 points away. You take that plus the net credit received, and that's where we get to our break even. Okay. Bottom line is, once again, there's only one break even. Usually you're doing this, the market is down here in this range. The market is in this range, and you're putting this together hoping that the market either drifts up or stays down. Okay. Now, these trades are only usually feasible in larger priced underlyings. You need some premium. You need either some implied volatility, some fairly pumped up option contracts to make this feasible to do this trade. But it's a great alternative to a short spread. And we're going to look at a stock. We just happen to be doing this show ahead of a $1,000 stock that's going to be announcing earnings, which is Costco. And because of that, it makes a very interesting shorter term trade that can be done around the earnings event on an expensive underlying. Once again, not meant to be a recommendation, but we'll look at scenarios where these might be alternatives to doing a short call spread. All right, so here's the combination. Here's the way that it looks. If we do a bear call spread, quite simply, and I'm assuming that if you're coming to this event, you've probably done this trade before, because we're going to the next level, right? If not, you're behind, I guess. It's great to learn all the different strategies that are out here, but a short call spread is, I guess, the next level. If you're starting out buying calls and puts, maybe you do some covered call trading. Next step is to buy debit spreads. Then we're looking at credit spreads, and then we combine the two and we come up with a butterfly. And that's how we get to it. That's the natural progression. So if we have a bear call vertical spread, otherwise known as a short call spread, otherwise known as a call credit spread, stock is trading down below the strikes, somewhere down here. We're going to sell a call, and then we're going to buy a call. And if we sell that call, we need the market to go down. If we buy the call, this is our protection. Usually you have a high probability of success because you need the markets to either stay where they're at or drift lower. Even if they drift a little higher, you're okay. This is a staple of a lot of the trades that are recommended inside the First Trade platform that are generated by the Options Play platform. Now, here's an alternative. Here's what we're going to do. If we take this trade and we add the butterfly to it, we come up with our skip strike. All right. So to take the first iteration of our butterflies today, we had a standard butterfly, very popular in index options with 0 time to expiration. These butterfly trades, and we're going to have a seminar here fairly quickly, I think before the end of the year for sure, that it talks about 0 DTE trades. And one of the more popular ones is a butterfly because you want huge rates of time decay, and you can't get higher time decay than you can with a 0 DTE option, an option contract that only lives for 1 day. So you have limited and known risk, which 0 DTE options are very risky, and you want time decay. And that's a huge part of the 0 DTE options, is that they decay very rapidly. All right. So butterflies are very popular on those option contracts. Now, we're going to take this and we're going to go to the next step, and we're going to say, all right, that's great, but I like to do a lot of short spreads. I like to do bear call spreads. Well, how about we combine the two? So this is the strike that we're skipping. We've got the butterfly. Normally you would buy that strike. We're going to skip it. Now you could say you bought it, but then you sold this bear call spread, right? And you sold the same thing. So why even deal with that strike? Let's just skip it. And then let's buy a strike further out. When we do that, that means that we're embedding this bear call spread in. Obviously, a bear call spread brings in a net credit, and hopefully that net credit pays for the cost of the standard butterfly. So butterfly plus short vertical spread or short call spread or bear call spread equals a skip strike butterfly. And that's what we end up with. So if you're going to do this, you could see that the only way that I want to do a butterfly where I'm skipping the strike and I'm embedding that short spread is if I can get it done for a net credit. That's the benefit. I'm adding additional risk. If you go back to here, right? This red area on the way up is a lot smaller because it's only the net debit paid than this red area, where this bear call spread brings in that additional risk. But you're not paying a debit, you're receiving a credit. And because of that, when you combine this, you're adding risk to the butterfly, but you're opening up the possibilities of making a profit on your butterfly trade by doing that trade. All right, so now my name is Brian Overby. My X handle is @BrianOverby. My book is called The Options Playbook. I'm going to allow you to type in any questions that you may have along the way, and then I'm going to open up I'm going to stop sharing for a second, and I'm going to open up, actually I think I might just be able to hit escape here. And let's go to the Options Play platform. Okay. A couple of underlyings that I liked that I was looking at, and we were talking about a little bit on Tuesday. One of them is gold, and inside the Options Play platform, I actually received a bearish counter trend trade, which means that gold is getting a little frothy. We set a recent high. Now I'm looking at the GLD, which is how do I want to say the ETF that tracks gold prices, right? And we're going to lean bearish on this. And I'm going to look at a standard butterfly and then look at an open wing butterfly. So I want to look at both of these trades. And I just want to set this up, and we'll leave it there. I'm trying to keep these things a little bit shorter. But once again, not meant to be a recommendation. Very important that I want to emphasize that. But this is an underlying where you've got a fairly pricey underlying, and you have some volatility with some predictability. I know that's an oxymoron, right? But gold prices aren't going to, it's not like gold is going to get taken over tomorrow. It's a commodity, right? And this is an ETF that tracks the prices of that commodity. So huge shocks, you can get some huge, I'll let it go, all right? This is an underlying that I find it interesting to do the trade on. So let's set one up. We're going to look at, I'm just going to hit bearish because we're leaning bearish because we received this counter trend alert. And we're going to go short term. When I'm looking at butterflies, I don't usually want to go, there's instances where, there's no golden book of answers, but, a week or maybe two, because you want that time decay to go away. So it's a way to speculate on a shorter term move on a trade. And this is going to be neutral to bearish. If the market stays where it's at, we're going to be okay. But if we do get the market to go down, we're also going to have that situation. So here we are. We're going to put this, we're going to modify this trade. We're going to be on the bear side of things. So we're looking at puts. We're going to go a little bit in the money, the 340 strike. Let's go up on top of that. Let's hit the 350. Come on down. We're going to look at the 344. So I'm going to sell something very close to where the underlying market is at, 344. And then we're going to, let's start with the standard butterfly. So this is 6 points wide. So let's add one more leg so that we can look at this. And we're going to change the expirations up. Well, I'll just do that right now. 16, let's go to 2 weeks. 2 weeks is a good number. Then we can just say 2 weeks. And the standard butterfly, it's going to be fairly inexpensive, right? So this is 6 points and 4, so we're going to go down to 38. And also it's a very liquid underlying, so there's a lot that we can trade here. All right, so if we look at our profit and loss graph, here's our butterfly. Obviously the underlying market's right here. If you just even look at a chart in gold, let's pull this over here. Come on. Yeah. There it goes. And we'll zoom in. Like you see we had a solid, strong up move, but there's not a ton of gap openings. We had the market come all the way up, actually hit a new high right here, received the bearish counter trend signal, but the range, like the consolidation, was on the downside 325, on the upside 340, so about a 20-point range that it would stay in. And some volatility, some predictability. That's what these are the underlyings that these type of strategies make sense in. And so we're here. We like the market just to stay where it's at, but if it goes down, we also want to be profitable. So to start with, we're looking at the money butterfly, and we can get this done for $1.29. So fairly inexpensive. We're going 14 days out. Our max risk is going to be $1.29. Our max upside will be $4.71. And once again, it's the difference between the strikes. So from 350 down to 344, that is 6 points. And then obviously the other leg is also 6 points in this trade. Now, if we do the open wing, this will go a little bit more expensive, but we'll see our profit and loss graph change, right? Right now we have, you see the red, I'm going to get rid of that to get rid of that. Okay, I'm just going to point below the graphic. But from here on up, if the market breaks up to the upside, you have the max risk of that $1.29, and that's our max risk of $129 per 1x2x1 butterfly. If it goes all the way down, you have that max risk of $129. So fairly inexpensive, but you need it to stay within the range. We're going out 14 days. That range is going to be 6 points to the upside, 6 points to the downside. You want it to stay within that range. Okay, now let's modify it. And this is 6 points. And I already know that I need to do this because I've done a lot of these butterflies overall. So on the downside, we're going to stop short. I think we're going to do the 2 points wide. So 6 in that, that'll be 4. See if we can get this done for less than 4. 42. Yeah, and that changes everything here. All right, let's hit this. So now you have to say, is the cost worth the reward, right? Everything's a trade-off. So we paid $1.29, so it's almost double that. We're paying $2.53, and actually I might modify this one a little bit more. Once again, we're using real markets. This is 15 minutes delayed, actually 20 minutes delayed, but we're using real numbers, not meant to be a recommendation. Got to keep tossing that out there. 253. Now that means that if the market stays where we're at, it's still the width of that long spread. It's still $6 minus the 253. So the max reward here is $3.47 if it stops right at that midpoint. If the market continues on down though, we are also profitable. And I'm going to put my cursor right there, and you can see that if at expiration the stock is below our 42 strike, 342, then we can actually make $1.47 on that expiration. Or if you want to get technical, you can actually do the math here, but we're going to round it off to $1.47. So on the max upside, we can make 347, or we can make 147 if the market continues on down on that trade. Open the wing, we pay more up front, but we have a scenario where if the market stays the same, we do great. If the market goes down, we do okay. We're still just fine. We're only hurting if the market continues on up in that scenario. So now we can go in and modify. I want to modify this, and let's look at one less strike and see if we still stay profitable here. See if we can bring the cost down a little bit more. Let's go down to 41. Yeah, so now that brings the cost down to 216. And let's look at that profit and loss graph. Now on the downside, we only make 84. We got a wider range within this area, and it costs $2.16. So it doesn't increase the cost too much more. But if we go too far, if we do the next strike, well, then we're getting close to the standard butterfly, right? So these are all about trade-offs. So let's look at the modified. Let's go down to make this 4 points wide. Now we're paying $2, so we're going to save almost 30 cents. $1.83. But now if we look at the profit and loss graph, on the downside, we can only make $17, right? So we get it down to $1. We started at $1.29. Now we're at $1.83 for a 14-day trade. And if the market goes down, we basically break even, right? If you take out fees and commissions, you're at $17. On the upside, we obviously can't lose as much as the market goes up because our cost is the net debit paid, and that's going to be our max risk and our max reward. So interesting underlying, interesting way to set up the trades, how to modify the trades to fit your forecast or your liking, but pretty straightforward as to adjust the butterfly to fit a risk profile that you don't mind trading. Now, remember, this is an alternative to just doing the long put spread. And if we just did the long put spread, right, you would look at, well, this would be a little bit at the money, but let's modify it one last time. And we'll just buy this one and sell one of these. Okay, delete that leg. And look at this trade. Now the cost goes up immensely, $3.38. This isn't one that you would necessarily set up because you'd sell this a little bit more out of the money. But just so that you can see the comparison, you have a little bit more upside. If the market does go down at well, let's pull it up this way. If the market does go down at expiration, you're looking at a max profit of this trade of $2.62, but you have more risk up front. You got to pay $3.38 to get that. Market's just got to go below that range, but that's also what you want to happen on your open wing butterfly. Anywhere from the where on down, we're fine. If it continues on down in the open wing, you don't make as much, right? But you have more upfront costs by doing it this way. All about trade-offs. All about trade-offs. I think there's a place for any of these strategies, especially if you like to do the shorter term trades, like an underlying, and I'm not going to get into it today, but you know, I don't think I want to put one together on Costco because there's an earnings risk, and once again, I don't want these to be recommendations, but they're announcing earnings. It's $1,000 stock or $950 stock. Interesting way to play around and see what type of strategies you can do in the butterflies in that space. All right, I'm going to go back to here, pull this up, and I'll answer any questions. I don't know, is this a little bit too advanced of a topic? I don't have any, because usually I get a lot, I see that there's still, everybody's hanging around, but usually I get a lot of questions whenever options play comes over and talks to the First Trade crowd, just a very astute crowd over at First Trade. But if there are no questions, then I always like to leave you with this. May all the options that you buy finish in the money, and all the ones that you sell finish out. Thanks for coming in, and we'll see you in a couple weeks' time for a next educational session, and we're going to get into four-legged trades, looking into iron condors and things that are done for a net credit. Thanks for coming.